Hi everyone. As we know, Bank of England has increased base rates to 1.75% from 1.25%, with further increases expected this year, possibly rising to 3% or more. This is the biggest rise in 27 years. The rates have been hiked 6 times since December 2021, where the cost of borrowing stood at 0.1%. Target for inflation is 2%, but currently stands at 9.4%, with suggestions this could now be heading for 13%. As we know, the factors are mainly the cost of living crisis and the Ukraine war. We're also looking at plunging into a recession, which, according to the Bank of England, could be with us for 2 years. We know all these factors are putting the squeeze on household budgets and will only get worse. Although I've painted a gloomy picture, this does give you the opportunity of opening discussions with your clients who may be looking for help with their finances. We're seeing many fixed rates coming to an end, with spikes in September, October, and December. Offer validity periods will allow you the opportunity to lock in fixed rates for your clients up to several months before their remortgage is due to be looked at. I recently caught up with Matt Martin, National Account Manager from Virgin Money, and asked him whether product transfers are a sensible option when considering your clients' remortgage options.
Yeah, so I think this year, finding the right remortgage for customers could help them navigate the rising cost of living. The increasing cost of living it will impact millions of households. You know, inflationary pressures, rising energy costs, and tax increases mean many customers are going to start to already feeling the financial pinch. You know, we've recently heard the announcement that the consumer price index hit roughly 9.5% in June, continuing to hit the trend at its highest level in 30 years. And the energy price cut hike of 54% that took effect from April meant sharp increases to clients' energy bills. So we talked about how many that's going to affect, and we think it's going to impact 22 million households. And debt charity Step Change has already found that nearly 1 in 3 adults are now struggling to keep up with bills. And to put that into perspective, this number's doubled since the start of the pandemic. So taking into that all of that into account and answering your question, UK Finance predicts that remortgage business will increase to 69 billion this year from 62 billion last year, and that product transfer business will rise to 205 billion this year from 184 billion last year. And actually, early and mid 2022 stats have significantly seen the increase in that activity. So plenty of opportunity for brokers out there.
So brokers need to keep in touch with their clients.
Yeah, many clients will have deals expiring during the latter part of this year, latter part of 2022. By checking in with them now, you could help them to lock into a fixed rate and also preempt any problems if they're worried about making their monthly payments due to rising bills. Mortgage rates are on the increase, as we know, in line with recent Bank of England changes, and swap rate increases. And the Bank of England has hinted that it will raise its base rate again during the latter part of 2022 to curb further rises in inflation. It's never too late, and now is still a great opportunity for borrowers to secure a fixed rate and fix their costs. You know, clients might not be aware of that, and they need a trusted expert to guide them.
Where do you think product transfers fit in a broker's offering?
Product transfers are and have been for a number of years. They've been a vital tool for advisors, but I guess more so than ever this year and into next as well. And hopefully it goes without saying that if they want to give their client the full picture, absolutely advisors need to look at all of the client switching options. You know, it's always good practice to check what's on offer from the client's existing lender, in addition to the obvious or potentially obvious remortgage options. But this year, a product transfer could be particularly beneficial, especially for borrowers who could struggle to refinance. With new mortgage rates rising and affordability criteria being tweaked to account for, you know, higher costs of living, some clients could find it hard to borrow what they need to with a new lender.
Do you think a remortgage could be more of a tricky place for some people this year?
Potentially. So the cost of living crisis is beginning to bite, and the energy price cap, as I've talked about, has increased and is expected to increase yet again in October, and then coming again in January. So meaning many households will face further bill hikes this winter. At the same time, there's set to be a spike in mortgages coming up for renewal at the end of the year. So if we go back to some numbers again, if we look at the specifics, there's an estimated £137 billion worth of mortgages set to renew between August and December this year. The largest months for maturities within that, we've got September at 33 billion, October at 33 billion, and then December slightly higher at 36 billion. So lots of opportunity. The remortgage spikes are a great opportunity for advisors to help their clients secure a new deal and avoid moving onto the lender's standard variable rate. To the point, though, it might not be without its challenges. If customers have experienced financial problems due to the cost of living crisis or even the pandemic, clients' remortgageability could be impacted. So this is all happening in the context of rising mortgage rates on new deals and standard variable rates. So it makes sense for borrowers to start looking for a new rate earlier than later, and for advisors to be part of that journey. If I think about our own brands, with Virgin Money, you can apply 120 days in advance of the client's maturity. And with Clydesdale, it's 180 days in advance. Not forgetting that we have seen some changes recently in the market where lenders are now allowing PTs to be submitted 6 months in advance of the customer's maturity. This is all happening in the context of rising mortgage rates on new deals and standard variable rates. So it makes sense for borrowers to start looking for a new rate earlier rather than later. And I'd encourage advisors to clearly be front and centre of that journey. If I think about our own brands with Virgin Money and Clydesdale, you can apply well in advance of the client's maturity. And actually not forgetting that we've seen some changes recently in the market where lenders are now allowing PTs to be submitted 6 months in advance of the customer's maturity. We look at some rates. The average 2-year fixed rate was 3.74 in July, 1.4% above its level in December 2021, so last year, where it was 2.34%. And its highest level in over 9 years, according to Moneyfacts. If we look at average SVRs, they've breached 5% for the first time in 13 years. So actually doing nothing is unlikely to make sense for most clients.
There's some great figures there, Matt. You and other lenders are still clear that product transfers are a sensible option. Is that correct?
Absolutely. Yeah. When you check out your client's remortgage options, include product transfers with their existing lender. For starters, they could offer the best and most competitive rate available to them. But they come with a raft of other benefits, of which I'm sure are not lost on brokers. Your client should be able to secure a product transfer rate early, ready to switch at the end of their current product period. And that means they can lock into today's rates and protect themselves from future rises. As I've said, with some lenders, they might be able to secure the rate 3 months before actually switching, or even earlier. Of course, they can also do this with a remortgage, but the process of getting a mortgage offer is likely to be quicker and easier with a product transfer. So that's just one of the benefits. And as I've said as well, I'll go back over it, but with some lenders, including Virgin Money and Clydesdale, the switching process can be done quickly and easily online, often with no valuation or legals required. Product transfers are particularly useful for clients with limited remortgage eligibility, as we've already talked about, as the lender already holds the risk and doesn't need to make the same affordability checks. They may well have seen their income drop, have experienced a credit blip, or have recently become self-employed and don't have sufficient accounts history to get a remortgage. And of course, we can't forget, many lenders now pay a prop fee to brokers to recognise the work that the advisor has already put in up front, advising the client on all of their options. Ultimately, advisors' clients just want the best mortgage products for their needs, arranged as quickly and as smoothly as possible. It always makes sense to consider product transfers alongside remortgages, and never more so than in 2022. If their mortgage is up for renewal before the end of this year, make initial contact with clients now. See if their needs or circumstances have changed, whether they'll be able to access a new remortgage, and how quickly they can secure a new rate with their existing lender in advance of switching.
Thanks, Matt. With the squeeze expected throughout the rest of this year and everything we've already talked about in terms of remortgage or product transfer, are there any hints and tips you would give brokers?
Yeah, there's a few here. So, if we're talking about people's income being squeezed, I think absolutely as an advisor, you need to get in touch. Ask if your client needs any support or if they think they might struggle to meet mortgage payments and other bills. If after that conversation they are concerned, I would signpost as an advisor. I would signpost the customer to their lender. You know, Virgin Money and other lenders would always try to support borrowers in difficulty and come up with a manageable payment plan. Talk to the customer about reviewing their overall budget, spring cleaning their outgoings by looking at the best deals and cancelling any unnecessary direct debits. This could put their finances in a better position and also boost their remortgage eligibility as well. I've said it a few times, but secure a rate early. You can usually do this in advance of your client's expiry date. And as we've talked about, a number of lenders on the market now allow that anywhere between sort of 3 and 6 months before their rate matures. And again, you know, this one I couldn't talk more about, but contact clients well before their current product expires to give you the time as their advisor to assess their options. You know, you may need to build in extra time if they have non-standard circumstances or limited remortgage eligibility. In that case, remember to consider a product transfer option for them. So hopefully it goes without saying that by being proactive about the cost of living squeeze, you can demonstrate that you're looking after your client's best interest and help them manage what's likely to be their biggest outgoing.
Moving on, Matt, do you think there are other opportunities when it comes to a remortgage and product transfers with additional borrowing?
Yeah, I do. So to start, as we've seen, property prices and house price index increases. Clients may well qualify for products within lower loan to value brackets than they had originally expected. You know, imagine a scenario where a customer falls from a 75% loan to value banding to 60% banding and giving that news to the clients on the savings they could be making on their product. And then this also leads nicely onto perhaps additional borrowing. You know, there will be people who are put off with the cost of moving, but if they have that little bit more equity in their property and perhaps have fallen into a lower loan to value bracket, borrowing more money to extend or convert existing homes may well be more of an option for clients. And then factoring in the potential for additional borrowing gives a really nice opportunity for advisors to talk everything green, um, both in the residential space and buy to let space. You know, for the latter, we have regulation working its way through that for existing tenants and new tenants by, at the moment, 2025 and 2028 respectively, the EPC of tenanted properties needs to be at least a C. Potentially now is the time to sit with landlord clients to discuss the options of upgrading properties. Slightly more tricky in the consumer space and residential space. But if customers do want to improve homes and improve their EPC ratings, most lenders allow additional borrowing for home improvements. And that's going to include elements that will assist with lowering carbon emissions. And let's not forget, you know, protection, income protection, life insurance. You know, remortgages and product transfers are still a great opportunity to sit down with a customer to review their circumstances from a protection point of view.
Yeah, I'm glad you touched on that. I think, from my podcast, I always talk about the mortgage side, but you're right in what you're saying there. The advisor also needs to protect the mortgage payments as well. I think you agree. Matt gave us a good overview of this market. As we've said, now is the opportunity to contact your clients who are in this position and help ease the pressure of their budget. Act now and help them secure more suitable rates if they're looking at remortgaging sooner rather than later. This is an opportunity of helping clients ease the pressure on their budgets. To help with marketing campaigns, we have a selection of templates available. These are attached at the end of the podcast. I'm going to finish again by emphasising lenders are still under pressure to meet SLAs. We've seen Coventry and Suffolk Building Society put a temporary halt on new business due to excessive volumes of applications. Could more follow? I know I appear to be repeating this, but always check the rate and product is still available with a lender before submitting the application and manage your client's expectations. Hope you found this useful. That's all from me, but listen out for my next podcast.